Silver's true movements aren't driven by headlines, but by the maturity of its contracts. The futures market provides liquidity, price discovery, and hedging for commodities. Yet it wasn't designed for large-scale physical delivery. Most contracts settle in cash. The system relies on the assumption that physical demand remains a fraction of open interest. This critical assumption is rarely examined closely, hiding a deeper structural dynamic. We'll explore how a paper silver market operates with claims far exceeding available metal. Delivery stress signals more than a temporary imbalance. It points to systemic issues. The phrase 9 days left isn't a countdown, but a structural limit in monetary systems. COMEX is an exchange, not a vault. It trades standardized claims on silver. These contracts represent specific quantities, deliverable under defined conditions within a month. Open interest can vastly exceed warehouse inventories, relying on netting and settlement. As long as participants roll contracts or settle financially, physical inventory remains adequate. The contradiction is quiet. The market setting global silver prices trades primarily in promises. This isn't fraud. It's the inherent design of futures markets to expand liquidity. Leverage allows traders to control large quantities of silver with minimal capital. While enhancing participation, this leverage inherently multiplies claims on the underlying asset. Registered silver in warehouses is available for delivery against futures contracts. Eligible silver is stored in approved facilities but not necessarily committed for delivery. This distinction becomes crucial during periods of market stress and high demand. If delivery requests surge, the exchange faces a logistical test to meet obligations. It must facilitate transfers, encourage cash settlement, or reduce open positions. Most months, this process is uneventful. The system functions smoothly. When it's not, tension reveals itself quietly in spreads, lease rates, and inventory movements. The idea of COMEX having limited days left suggests urgency, but the true urgency is structural. Futures exchanges operate on confidence that obligations can be netted efficiently. If participants insist on physical delivery, the leverage in paper contracts becomes visible. This sudden visibility of underlying leverage can unsettle the market. Silver holds a unique place in monetary history, serving as coinage for centuries. It functioned as both industrial input and monetary reserve, a dual role. 19th century debates over bimetallism reflected tensions between gold and silver. When nations abandoned silver standards for gold, monetary systems contracted. This shift unfolded over decades, reshaping global trade and debt structures. The lesson isn't nostalgia for metallic standards, but the tension between physical assets and financial claims. Modern monetary systems are fiat-based, not convertible into metal. Yet, precious metals retain psychological weight as tangible stores of value. When futures markets expand paper claims far beyond physical stock, they depend on trust. Trust can absorb imbalance for extended periods, maintaining stability. But trust erodes before failure becomes visible, often subtly and silently. In the late 1960s, the London Gold Pool tried to maintain gold prices. Central banks coordinated sales to suppress upward pressure, draining reserves. The pool collapsed quietly in 1968, preceding the end of dollar convertibility in 1971. It weakened until support became unsustainable, not imploding overnight. Silver markets have seen similar episodes. In 1980, the Hunt brothers cornered silver. Prices sharply rose, but exchanges responded by altering margin requirements. They imposed position limits, leading to a price collapse. Rules adapted. This episode revealed how regulatory mechanisms shift to protect systemic stability. When stress appears, rules adapt. This adaptability preserves order. However, this very adaptability also signals an underlying fragility. If COMEX delivery volumes strain registered inventories, the exchange has tools. It can raise margins, incentivize cash settlement, or adjust reporting classifications. These measures prevent abrupt disruption, maintaining market order. However, they do not eliminate the underlying tension within the system. The silver futures market, a complex dance between paper claims and physical reality. Understanding its structural dynamics is key to navigating its hidden tensions. Paper to physical ratios in silver futures fluctuate, indicating leverage relative to available metal. Under normal conditions, this leverage enhances market efficiency. But under stress, it magnifies concern. The concern extends beyond silver itself. It's fundamentally about confidence in price discovery mechanisms. When benchmark prices rely heavily on financial settlement, not physical exchange, questions of representation arise. Representation is crucial, especially within global reserve currency systems. The United States dollar remains dominant, partly due to its deep and liquid financial markets. Treasury markets, equity markets, and futures exchanges all contribute to this vital credibility. If credibility erodes in one segment, it inevitably influences the perception of the entire system. This isn't to suggest an imminent collapse, but rather to observe the profound interconnection. Persistent silver delivery stress may signal broader liquidity strain across financial markets. Liquidity strain reflects tightening conditions, often following periods of excessive leverage. Leverage has expanded across asset classes for decades through derivatives and structured products. These complex instruments fundamentally depend on orderly settlement processes. In 2008, mortgage derivatives amplified systemic risk, revealing a web of layered claims. Silver futures are simpler by comparison, yet the underlying principle remains similar. Multiple claims exist on a limited physical supply of silver. As long as few claim delivery, the system maintains its balance. However, if more participants simultaneously claim delivery, an adjustment inevitably follows. This adjustment doesn't necessarily mean failure. It may simply mean repricing. Repricing alters perceptions of scarcity, influencing investor behavior. This behavior shapes capital flows, which in turn affect currency strength. Currency strength underpins reserve status, extending a quiet chain outward. Historically, monetary transitions often begin subtly at the periphery of the system. In the late Roman Empire, silver coinage was gradually debased, a visible sign of declining trust. Trade patterns adapted long before formal collapse, reflecting a deeper shift. In the 1930s, gold convertibility constraints forced governments to suspend redemption. Exchange mechanisms strained before political acknowledgement, highlighting underlying tensions. Each episode involved tension between physical reserves and financial claims. COMEX operates within a fiat monetary framework. Its silver contracts don't anchor currency value. Yet, physical delivery stress evokes older monetary anxieties, suggesting limits to financial abstraction. Abstraction allows for scale, enabling greater leverage within the system. However, leverage introduces fragility, which in turn invites intervention. Intervention stabilizes temporarily, but this cycle repeats across eras. The phrase 9 days left implies a countdown, but delivery periods are procedural. Notices are issued, positions matched, and warehouse receipts transferred. The system anticipates peaks in demand, but persistent declines in registered stocks are observed. Observation influences expectation, and expectation precedes action. Action may involve shifting exposure to physical markets, alternative exchanges, or bilateral contracts. Such shifts fragment liquidity, reducing transparency in the market. Reduced transparency undermines confidence, which rarely restores instantly once diluted. The decline of reserve currencies follows similar patterns of gradual diversification. Trade settlements adjust, and bilateral agreements increase over time. No single event marks the transition. It's a cumulative process. Silver markets may not determine global monetary order, but their stress reflects underlying strain. Debt accumulation across economies amplifies sensitivity to liquidity disruptions. When credit tightens, investors reassess risk across all asset classes. Precious metals often attract attention during periods of uncertainty. If futures markets struggle to accommodate delivery preferences, premiums may widen. Such divergence indicates imbalance, but it need not escalate into collapse. It may normalize through rule adjustments, revealing dependence on administration. The more frequently rules change, the more participants recognize contingency. Contingency alters trust, which erodes incrementally over time. COMEX has operated for decades through varied market cycles, showing resilience. However, resilience relies on confidence that physical delivery remains credible. If credibility weakens, participants may demand greater transparency. Transparency exposes ratios previously ignored, inviting scrutiny. Scrutiny affects participation, which influences liquidity. Liquidity in turn determines stability within the market. The pattern is subtle, unfolding in spreads, warehouse reports, and margin adjustments. Most observers focus on price, but price is only one signal. Inventory levels, lease rates, and backwardation reveal deeper currents. When futures prices trade below spot prices, backwardation emerges. It can indicate immediate physical demand exceeding supply. Backwardation in precious metals is uncommon during normal liquidity conditions. When it appears, analysts debate its significance. Debate itself reflects uncertainty. Uncertainty rarely resolves quickly. Monetary systems adapt to uncertainty by increasing coordination. Coordination centralizes control, centralization reduces spontaneity. Spontaneity once characterized commodity markets. Modern derivatives markets are highly regulated and interconnected. Interconnection amplifies both stability and risk. If silver delivery strain persists, it may not dismantle the exchange. It may prompt reforms. Reforms may include stricter position limits, higher margins, or revised delivery procedures. Such changes preserve order. They also signal threshold. Thresholds are rarely acknowledged in real time. They are identified retrospectively. When historians examine past monetary transitions, they often find early signals dismissed as temporary anomalies, inventory drains, spread anomalies, margin adjustments. Only later do these appear consequential. Silver has long served as a barometer of monetary anxiety. When fiat systems expand credit rapidly, precious metals often reflect skepticism. Yet skepticism alone does not alter structure. Structure changes when participation shifts. If enough participants prioritize physical settlement over financial settlement, the leverage ratio compresses. Compression reduces liquidity. Reduced liquidity increases volatility. Volatility invites regulation. Regulation reshapes markets. Markets rarely return to previous form. This is how transformation unfolds. Not through sudden expiration, through gradual redefinition. COMEX, having limited days left in a delivery window, may capture attention. The deeper question is whether the underlying ratio of claims to metal remains sustainable. Sustainability depends on behavior. Behavior depends on trust. Trust is cumulative. It weakens before collapse. It shifts before replacement. Monetary history teaches that systems rarely fail at the moment predicted. They evolve until previous assumptions no longer hold. If silver delivery strains intensify, the adjustment may appear technical. It may feel administrative, it may be resolved quietly. Yet the memory of strain lingers. Participants incorporate it into expectations. Expectations influence future behavior. Future behavior shapes liquidity. Liquidity underpins pricing. Pricing influences capital allocation. Capital allocation defines economic structure. The path from warehouse inventory to monetary architecture is indirect but real. Precious metals are not central to fiat currency backing. They are central to perception. Perception affects confidence. Confidence sustains leverage. Leverage defines fragility. Fragility invites adaptation. Adaptation alters systems incrementally. By the time observers declare that something broke, it has already been reconfigured. COMEX may continue operating, silver contracts may settle, warehouses may refill. Yet if the ratio between paper claims and physical supply tightens persistently, the perception of abundance changes. Abundance underwrites stability. Scarcity challenges it. Scarcity need not be absolute. Relative scarcity within leveraged systems suffices. This is how monetary transitions begin. Not with empty vaults, with questions about representation. And when representation is questioned repeatedly, confidence narrows. History records many such narrowing moments. The London gold pool, the suspension of convertibility, the gradual debasement of coinage. Each began with imbalance between claims and reserves. Each ended not with silence, but with redefinition. Silver delivery stress, if sustained, may represent one such narrowing. Not an end, a threshold. And thresholds, once crossed, rarely restore the previous architecture unchanged. Money changes quietly, trust migrates slowly. And by the time a delivery window closes, the structural adjustment it signaled may already be underway. That is how monetary systems shift, not abruptly, but through cumulative strain, administrative response, and gradual reconfiguration. Silver moves, contracts settle, warehouses report. And beneath those reports, confidence recalibrates. That recalibration, not the countdown, defines the era.